Something broke, quietly and without a crash. The US economy slipped into negative growth last quarter. GDP for Q1 of 2025 came in at negative 0.3%, marking the first official contraction since the, pandemic dip. But this time, there's no pandemic to blame. There's no war, there's no singular obvious cause. This time, the cracks are forming in all directions, slowly, silently, and most people are still pretending that the walls aren't caving in. Let's start with the airline industry, because if you're going to experience economic turbulence, you might as well do it at 30,000 feet in the air with a crying baby, $20 Wi-Fi that doesn't work, and maybe it's a Boeing so the door's going to fall off. Southwest CEO said out loud recently what no one on Wall Street wanted to admit. The US airline industry is already in a recession. Not might be headed for one, not watching closely, but already there. Why? Business travel never really recovered post-pandemic. Zoom killed half of that demand. And corporate budgets killed the other half. Leisure travel had a short-lived boom, but inflation and higher interest rates, they're now choking that out too. Plus, throw in the rising fuel costs thanks to the trade war and softening demand across major routes, and airlines are flying half-full planes at full price just to cover the costs. And if airlines are hurting, that's just the canary in the coal mine. That's the first scream you hear, because air travel is discretionary. The next shoe to drop? Food. Not fine dining, not meal kits, fast food. McDonald's posted a surprise drop in global same-store sales. Franchises are saying that foot traffic is way down despite new promotions and budget meals. Even the value meal is not pulling people in. Chipotle, usually a growth stock darling, is warning that its top-line growth is slowing. Customers are visiting less often, and when they do show up, they're ordering less food. Now let that sink in. We're watching fast food get priced out of reach for the average consumer. People aren't just trading down, they're opting out entirely. And that's a huge red flag, because fast food is supposed to be the last stop before just eat at home. If that started to slide, it means that wallets are genuinely being strained right now. And the ripple effect doesn't stop there. Let's talk about Walmart, the place where you go when you want to stretch a dollar just a little bit further. Everything's a little bit cheaper there. Reports on their earnings and third-party surveys are all pointing to the same trend. Shoppers are pulling back on everything non-essential. Groceries are still moving, but electronics, clothing, and general merchandise, they're all slowing. Walmart customers are cutting back not just inside the store, but across their entire lifestyle. Less travel, fewer restaurant outings, fewer impulse buys. When middle America starts retrenching, that doesn't just impact Walmart. It hits the entire system downstream, the entire economy, because these aren't luxury customers. These are everyday working class, blue collar people. And if they're tightening their budgets, you can bet the cracks are spreading upward. And here's the thing, it's not just hitting lower income households anymore. The pain is creeping into the middle class. People who used to feel financially stable, they're now watching their paychecks evaporate before the month ends. Mortgage payments, car notes, student loans, rising utility bills, they're all squeezing everyone for both sides. And when you combine that with credit card balances at record highs, student loans at record highs, it starts to feel less like a soft patch, more like a slow bleed. Meanwhile, household debt, it's quietly climbing. Credit card balances are back at record highs. Delinquencies are rising. And not just in subprime, but across the board. Personal saving rates are scraping multi-decade lows. Americans are financing everyday life on plastic again or buy now, pay later, not because they want to, but because they have to. And this isn't something temporary. It's not some holiday hangover. It's structural, and the pressure is coming from both ends. Tariffs, they're raising prices at the same time that wages are stagnating. Apollo research highlighted this specifically. They show that wage growth, adjusted for inflation and taxation, has flatlined for nearly 9 months. That means disposable income is not just staying flat, it's actually eroding with inflation, which explains why even the cheapest categories are beginning to wobble. Now let's zoom out a little bit. Apollo's internal model projects a summer recession, and they're not alone. What separates their analysis is the depth. They've been tracking the freight sector, commercial real estate, inventory cycles, and even consumer sentiment with pinpoint precision. They show freight volumes down 10% year over year. Vacancy rates in logistics hubs like Dallas and Atlanta are rising. And regional economies in Michigan, Ohio, and parts of the Southeast are showing outright contraction in job growth. They even laid out a scenario where oil price volatility, sparked by renewed Middle East tension and reduced domestic refining capacity, it could become the straw that broke the camel's back. If energy prices spike this summer, it won't just hit gas stations. It'll ripple through everything. Trucking, food, Food delivery, utilities, travel, every price tag gets heavier when energy costs rise. And corporate earnings, they're not immune. We've already seen weaker than expected results from Target, Home Depot, FedEx, and dozens of mid-cap industrial names. Many of them are blaming macro uncertainty or weather, but all that really means is that people aren't buying. Or if they are, they're buying less. And this isn't some seasonal thing. This is demand destruction playing out in real time. Even small businesses, often ignored national metrics, are sending up flares. Credit tightness is hitting Main Street harder than Wall Street. Regional banks are pulling back on lending. Commercial lines of credit are harder to get. And for small operators, your neighborhood mechanic, your independent cafe, this is the difference between survival and shutdown. One bad month and they're gone. There's also the psychological shift happening. We're moving from, I'm feeling pinched, to, I need to make some lifestyle changes. And that's dangerous because when consumer psychology flips, it takes time to recover. It takes time to get over that impact. And when conditions improve on paper, people hesitate. They wait longer to replace a car. They downgrade the vacation. They stretch out the life of their appliances. These micro decisions multiplied by millions, tens, hundreds of millions of households, and they can stall a recovery for years. And if you're waiting for a Fed pivot to save the day, you might be disappointed. Rate cuts, they're very likely coming. But the Fed is trying to manage inflation, market expectations, political pressure all at once, and they don't really have that much impact. They kind of just follow the 2-year Treasury anyway. And with midterm elections coming, everything's walking a tightrope. Cut too fast, and it looks like they're panicking. Cut too slow, and the recession deepens. This is a no-win situation. So what do? First, take off the rose-colored glasses. Hope is not a strategy. Prepare like the slowdown is real, because it is. Reevaluate your risk. If you have exposure to retail, hospitality, or small caps, like cyclical stocks, understand the downside. Second, lean into liquidity. Cash is not trash in a recession. Cash is optionality. It lets you act when others are frozen. It gives you flexibility when prices are irrational. That doesn't mean sell everything. Don't panic. It means be ready to deploy strategically. Third, understand that this environment it's not temporary. It's the result of delayed consequences. Tariffs over leveraged households, sticky inflation, fiscal tightening. It's all been building, and now it's here. And finally, don't get distracted by the noise. Headlines will flip every day. Analysts will say one thing Monday and the opposite thing on Thursday. But if you're watching the real economy, watching how people behave, where they shop, when they shop, and what they cut, you already know what's coming. GDP is shrinking, freight is down, consumers are tapped out. And Apollo says that the summer will only get worse. The recession is not coming. It's already here. And yet many people are still wondering, where are the layoffs? The answer is, they've already started. They're just not where you're used to seeing them. Trucking companies have been slashing routes for months. Logistic firms are downsizing. Hospitality is trimming hours, and many companies in tech and finance are freezing hiring altogether, just letting attrition lower their headcount. The big dramatic headlines might not be here yet, but the slowdown of job losses has already begun. And it always starts this way. Think about this. Most employers will do everything they can to avoid mass layoffs in Q1. No company wants to make headlines for cutting staff right after the holidays. But now they're moving into Q2 and Q3. And as the pressure builds, things could change. If revenue continues to weaken and costs stay high, companies will have no choice but to cut. The job losses won't be from one spectacular crash. They'll be the death by 1,000 quiet resignations, unfilled roles, and quiet terminations. On the consumer side, we're starting to see extreme substitution behavior. People are not just cutting back, they're fundamentally shifting how they spend, where they spend their money. McDonald's franchises are seeing customers drop drink orders entirely and share meals to save money. At Chipotle, fewer people are adding guac. Across the board, we're seeing the return of dollar store traffic spikes, and grocery stores are seeing more bulk buying, even among shoppers who never used to do that. This is classic recession behavior. And it's not just about spending less, it's about shifting into a mindset of scarcity. Consumers are no longer confident that next month will be better than this one, and that's a dangerous feedback loop. When people stop behaving in economic momentum, they start hoarding cash, saving extra money, delaying purchases, and voting with their wallets in everyday categories. Meanwhile, Wall Street is playing a strange game of denial and hedging. The bond market is screaming recession, 2-year yields have plunged, and futures are pricing in multiple rate cuts this year. But equities, they're still holding on. Investors are trying to have it both ways. Soft landing with one hand, multiple Fed cuts on the other. The math doesn't math. But you don't get aggressive monetary easing in a healthy economy. One of those beliefs is going to break. Someone's wrong. And when it does, markets will likely reprice quickly. Maybe not a crash, but a sharp correction across overvalued growth sectors, AI bubble, consumer discretionary stocks. Investors shouldn't be surprised if Q2 earnings bring guidance cuts in more language like headwinds, uncertainty, and softness in consumer spending. If you start seeing those phrases in everyday call, you know exactly what's happening. Break out the recession bingo card. Companies are preparing to lower the bar. One final note, this is the moment when leadership matters. Whether you're managing a household budget or a business, now's not the time to be passive. You need to get aggressive about planning, about saving, about hedging for the downside. Because when the headlines finally admit what is happening, the window to act will already be closing or maybe completely gone. So take inventory, tighten where you need to, stay liquid, stay focused. Because this isn't a false alarm. This is the real thing. The recession is already here. Thank you so much for watching. If you found this video helpful, please give it a like, subscribe for the YouTube algorithm, and leave a comment down below telling me what you think. Do you think Apollo's right and we're headed into a recession, or do you think they're wrong and the equity market's right? Thank you so much, and I'll see you next time.